Welcome to View from the Markets, the weekly video series from the Financial Times. We're here today in Shanghai with independent economist Andy Xie. Let's start first by talking about the Chinese economy. Last week, the inflation figures showed that inflation was at its highest level in the last 10 years. Are you worried about a surge in inflation in China? And does this show that the economy might be overheating?
Yeah, I'm a bit worried. I think that the economy is overheating. Mainly because that the trade surplus is very large. Also, there's hot money, so there is monetary access, and that is translating into inflation mainly through asset market speculation. I think that the problem is not as serious 15 years ago because the supply side in China is pretty robust and it responds to a price signal pretty fast. So the inflation is not accelerating like 15 years ago. But if the government is not careful, if savers believe the government is inflating away the value of money, then that people might rush out to buy things. That would really cause inflation to spike up. The government so far has done a reasonably good job. They are basically adopting an incremental tightening approach, always introducing new steps to signal to savers they intend to preserve the value of money. As long as they keep doing that, I think inflation can be kept probably at around 7% and not exceeding 10%.
If the government continues with these modest tightening measures, is that going to have a big impact on economic output?
What China is doing is not to prick the bubble. I think that they're trying to prolong the bubble because that by maintaining inflation expectation, the cycle gets extended. The correction in China will happen only when I think the U.S. dollar bottoms and recovers substantially. Then it will cause money to flow out of China. That's the correction will come. It's probably a couple of years away.
And should the government be thinking about accelerating the appreciation of the currency in response to this inflationary moment?
Yes, I think the government does think that the currency should be higher. But the problem now is that there's so much hot money in China waiting for the currency to go up. If the currency does go up a lot, and this expectation is satisfied, they may trigger a massive outflow of money, and it could lead to a collapse of the property market. So in a way, China is riding a tiger. There's this currency appreciation expectation. It's supporting the asset market. At the same time, that if this expectation is satisfied, the asset market could crumble down. So the government is going to move the currency gradually to make sure this expectation stays in China.
Now, this inflationary process in China is happening at the same time as you have the possibility of a recession in the U.S.
That's correct.
Would that have a big impact on the Chinese economy if the U.S. really does go into recession?
Yeah, on the one hand, it's a good thing for China because Chinese economies are overheating. The industrial production is slowing down a little bit, mainly because exports this year actually have been decelerating. I think that next year exports probably would be much less growth than this year, possibly from 20% to 10%. So that's welcome relief for the Chinese economy. At the same time, we have a hot money problem. The depreciation of the U.S. dollar is causing people to looking for safe haven. And the euro has already appreciated so much. And the Chinese renminbi has not appreciated by that much. And everybody believes it will continue to appreciate. So this safe haven instrument is attracting lots of hot money. So as the market speculation in China possibly will get a lot worse next year.
And what about the rest of Asia? How worried should those countries be about a slowdown or a recession in the U.S.?
I think it's a mixed bunch. Some economies are more exposed to the U.S. Than others, like Taiwan, for example, even though Taiwanese companies do a lot of businesses in China. But the Taiwan economy is very exposed to the U.S. economy. And the Korea quite a bit, and Japan in particular. I think the most exposed are Japan and Taiwan. The next would be countries like Thailand and Singapore.
And let's put this in the context of the broader global economy. This latest phase of globalization has been based partly on China essentially exporting deflation.
That's
and the constant lowering of prices of goods made in China. Has that process come to an end? Is it about to come to an end? And what does that mean for the global economy?
I think that yes, deflation from China is already ended. The prices in China are all rising. The export prices actually have risen. Even for textile products, the price have come up by 2 to 3%, 2 to 3 times, around 10%, and have been accepted by Western buyers. I think this process will continue. Nevertheless, Chinese prices are still low, but they are getting less low in the future. There are alternatives like Vietnam and Indonesia, Bangladesh, but we must recognize these countries do not have the infrastructure yet. It takes time for them to replace China as the low-cost producers. So I think these, what's going on in China from deflation to inflation will have a serious effect on Western inflation trend. The Western central banks cannot sort of cut interest rate whenever they see economic weakness. They have to pay attention to inflation.